The RBA board meets tomorrow. Will they raise rates again, or will there be a pause to see if the last 12 rate hikes have caught up? Joining me live now is AMP Chief Economist Shane Oliver. Shane, great to see you. So what's your prediction?
Well, we think they'll leave rates on hold, but I have to admit it is a very close call. And once again, economists are split on this one. On the one hand, services inflation is still too high. The Reserve Bank is very concerned about wages growth. And of course, the job market is still very tight. But against all of that, we did see those lower than expected inflation numbers last week. The inflation rate is actually falling faster than the Reserve Bank expected. We also got some very weak retail sales numbers on Friday, and retail sales have effectively been flat in nominal terms since last October and down in real terms, in volume terms. They're falling again for the third quarter in a row. And I think there's enough evidence now that the Reserve Bank is getting what it wanted, and it makes sense to therefore pause for another month and give more time for the lagged impact of past rate hikes to come through. So we're assuming, or we're hoping and thinking, the Reserve Bank will leave rates on hold, but I must admit it is a close call. And of course, it wouldn't surprise at all if the Reserve Bank moved again. It's surprised a few times lately, but that's our call, on hold.
Yeah, there's a couple of million households that hope you're right, but even so, if it's a hold tomorrow, might there be one more this year anyway?
Well, we're still allowing for one more because I think the Reserve Bank will still be concerned about high services inflation and wages growth. And it is worth noting that the Fed last week and the ECB, the European Central Bank, on Thursday last week, both raised rates again from even higher levels than the Reserve Bank has, despite having lower inflation than the Reserve Bank has. So, and there's all sorts of issues around that. Our households are far more sensitive to debt and interest rates than those in Europe and the US. But by the same token, we have seen other central banks keep going even with lower inflation. So that's why I think the Reserve Bank probably will still be a bit concerned, and that's why we're still allowing for one more. But I think the key in all of this is that we're either at or very close to the top. Yes, that there's a lot of pain out there in the household sector, those with mortgages that have been taken out, say, in the last 3 or 4 years. And those people are really hurting, and that's going to have a big negative impact on the economy. And of course, it's early days yet for the flow, the full impact of that to show up. But I think it will show up over the next 6 months or so. And I think we just run a very high risk of tipping us into recession if we just keep raising rates from here, just because the most recent inflation numbers are still too high.
I'll ask you about the recession risk in a moment, but talk to me a little bit more about services inflation. What services are we actually talking about here, and how persistent is that problem?
Well, if you think about the inflation story of the last 18 months, it started off obviously with goods prices, shortages after the pandemic, people wanting to spend on goods, shortages of cars, boats, everything, clothing, all sorts of things, and supply issues were the big factor there that led to that surge in inflation. And then, of course, with a lag, it's flowed on to services inflation as the jobs market has been tight. That's put some upwards pressure on wages, but that's probably not the biggest issue. The more pressing issue has been obviously the rise in rents, rise in power costs, and so on. And of course, the trend that we're seeing there is that services inflation is still going up, even though goods inflation looks to be rolling over. But if what we're seeing in the US is any guide, goods price inflation led on the way up, it's leading on the way down, and therefore services inflation will slow as well. And we are starting to see increasing signs that the jobs market is cooling with declining number of job vacancies. And I think that after, there is a risk the wages go higher from here, but if the jobs market starts to weaken, as we're seeing in the US, it starts to put downwards pressure on wages growth, which of course we are now seeing in the US, and we're about 6 months behind the US. So services is the big concern. But I think we've got to look a little bit beyond the electricity and power and gas and obviously rents. There's specific issues going on there. But to continue jacking up interest rates because of problems in those sectors, I think we'll miss the broader trend, which is towards one of lower inflation.
But that's the whole point, isn't it, Shane? You talk about petrol, rent, gas, the cost of electricity. Even if the RBA keeps on hiking rates because those items that I've just listed are too high, people can't stop spending on those things, and those prices aren't going to come down because they're the factors in housing. There's no short-term fix there. And when it comes to gas, well, they're because of issues outside of our control, unless the RBA can solve the war in Ukraine.
That's right. There's not much we can do about those things, but there's always a balancing act here. What the RBA is trying to do is to slow demand in the rest of the economy.
Right.
But there's only so far you can push that. You can push the rest of the economy into deep recession to try and offset, to try and get deflation elsewhere, offset price rises going on in those key sectors. But I think that will just be shooting ourselves in the foot. I think we need to allow that there are issues going on in those sectors. If the broader trend in inflation was up, as it was a year ago, 18 months ago, when we had the war in Ukraine, it wasn't just higher petrol prices at the time. Prices for everything were going up. It's a very different situation now. Yes, there's still upwards pressure on those prices, but don't forget that the surge we're going to see through this quarter, and most households have got notification of this. I certainly got a letter saying my electricity prices and gas prices were going up a lot, which is kind of a shocking letter to get. But the broader backdrop around that is very different to what it was a year ago when price of everything was going up. Now you've got a more deflationary or disinflationary impact working through the rest of the economy. The other aspect to note is that wholesale electricity prices have come down from their highs. So what we're seeing in terms of electricity prices at present is the lagged impact of last year's rise in wholesale prices. So once we get beyond that, hopefully the pressure will start to come off, at least power prices. And in case of rents, there is a little bit of evidence that vacancy rates are now starting to rise a little bit, which may take some of the pressure off rents, but obviously a fair way to go on that one.
Yeah, let's hope so. Okay, final question here, Shane. Is there a risk that the RBA has already gone too far? And I talk about the recession risk here.
That risk is high. We think the Reserve Bank probably has gone a bit too far.
Hopefully you're getting a delivery there, Shane.
It sounds like one of those deliveries coming, doesn't it? Not me. I think other members in my household get things delivered these days. But that's certainly a risk. We think the risk of recession is 50%. We know there's a lagged impact. We know from the late 80s experience when interest rates went up dramatically, unemployment kept falling initially. Then something broke and suddenly the economy fell into the recession that Paul Keating said we had to have in the early 1990s. And we don't really want to repeat that one again. But the lesson from that period was how long the lags take to impact. People get the rate hikes. It takes them a while to adjust their spending. We've been protected to some degree by the revenge spending, the reopening boost, the savings buffers, the people on fixed rates. Those have protected the economy, but those supports are now starting to fall away. And it gets more and more risky with each rate hike that we see, and that risk of recession gets higher and higher. And I think we don't need to have a recession to get inflation down. We're already seeing it come down without a recession. So that tells me that they've got a bit of breathing space here to go a bit more calmly, a bit more slowly, wait at least a few more months before moving rates again if they have to. But I think it does make sense to hold for a while.
All right, Shane Oliver, we'll let you go and get your Uber Eats delivery. We'll see you soon, hopefully.
Thanks a lot.